Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. Today we are going to speak at length about a healthcare space offering from the stable of Axis AMC. We'll also get in our expert Tarun Birani to comment on that and then give his views on some of the other funds. But okay, the point is Axis Mutual Fund has launched the Axis Healthcare Exchange Traded Fund. It's a passive investment offering from the fund house that is dedicated to the healthcare sector. Open-ended scheme seeks to replicate or track the Nifty Healthcare Total Return Index. And let's get in our guest today on the show to talk about what is this offering about, the timing of the offering, what kind of investors is it suitable for. Ashwin Patni of Axis MF joins us right now. Ashwin, good having you. Thank you so much for joining in. I hope all is safe.
Yes, hello. Hi, Niraj, and very happy to be on the show.
Thank you so much. So, Ashwin, tell us a bit about this offering. What is the nature of this, and then we'll get into, of course, the reasons and the timing, so on and so forth.
Yeah. So, as you said, it's the 2-3 important things to highlight in this is first is that it seeks to capture a very specific segment of the market, which is the healthcare segment. And I'm very conscious of the word healthcare because typically in India, we've had a very large, what we used to call pharma space, which is basically pharmaceutical space, which is the drug manufacturers. But this is a space that is getting broader in recent years as we've got other type of, players within the broader healthcare space. And the easiest example is, for example, diagnostics chains, hospitals and such like, who have also come into this space. So to recognize that this is now a much broader space, NSE came up with this new index, which captures the healthcare segment as a whole, and essentially has the top 20 companies of the healthcare index into this. So what we are offering really is a passive exchange traded fund that will replicate this index and give people, investors, a chance to really capture the entire healthcare space using a very simple, easy to understand single product.
Yeah, I'm guessing open-ended people can come in and get out the way they want, and I'm guessing the expense ratios would be very, very small, less because it's an ETF.
Yes, the expense ratio absolutely. So in terms of the open-ended nature, the nuance of ETF, of course, needs to be understood. So unlike normal mutual funds, where you can put in an inflow or a redemption with the fund house, exchange traded funds, as the name suggests, trade on the exchange. So the liquidity comes on because of the fact that these units can be easily bought or sold on the exchange. But yes, from a practical perspective, they are pretty liquid, and the liquidity works in an open-ended manner in that sense.
Right, and I'm guessing the taxation rules are similar. I mean, I just laid out everything for our viewers.
Yes, it's an equity fund. So the only thing that is different is the structure, which is the exchange traded structure of it, as I was mentioning. But in all other respects, the way for example, daily NAV gets calculated, the way portfolio gets constructed, taxation, all other aspects, it works exactly like an equity fund. Except that the nature of the investment operation, you have to buy and sell on the exchange. And in the NFO period, of course, we take applications directly, but post that, it will start getting listed and traded on the exchange. And once that happens, investors can directly buy and sell on the exchange.
Why the timing at the current point of time, Ashwin? That's the question. And does it in any way, how do I say, not conflict really, but contrast or cannibalize any of your existing offerings? I'm just trying to see if somebody wants to invest in the Axis AMC house, is there another suite of products or a product which is dedicated to healthcare, and therefore would this give me contrasting choices?
Sure. So let me answer the second part, which is very easy because we don't really offer sector funds traditionally in Axis Mutual Fund. The equity funds that we have are all broad-based, diversified products. And that was a very conscious choice because active management requires a certain amount of elbow room. You need to be able to allocate across a large number of different sectors, different opportunities to create a portfolio that can work for the investor. But at the same time, we also recognize that in the market, investors need more sharply defined products. There is need for special investors want to take specific exposure to themes, sectors that are very tightly defined. So in recognition of that, over the last year, we have started consciously doing a number of passive ETFs. We did one for banking, we did one for technology, and this is the third in that series where we have chosen the healthcare space to do it. The idea is very simple, that it allows investors a very sharply defined product. And because it's a very tightly defined product, a passive fund can reasonably sort of replicate the space. And there is not really much value that an active manager can really add in terms of stock selection or something.
Yeah, Ashwin. I understand you from the product side, but I'm just trying to understand in your conversations with either Jinesh Gopani, who I presume is the fund manager, or whoever else is going to manage this fund. I mean, it's a passive fund, but still, if you have somebody out here, what's the view that Axis AMC has on the space? I mean, is the timing right from a healthcare perspective? Do you have some thoughts here? It's okay if you don't, but if you do, would love to hear them.
So, like we said, broadly speaking, healthcare is one of the large material sectors in the market. Over the years, it's been represented by the pharma companies in a big way. Pharma companies continue to be a very big part of this space, but we are also seeing the emergence of new spaces like diagnostics, hospitals, etc. If you see this space, it's obviously it's gone through its share of ups and downs. Last few years. Especially 2016, 17, 18, those 2-3 years, we had a very tough period for especially the pharma companies, where they had a number of challenges which affected their numbers. And these are all well discussed. So I won't spend too much time there. What is happening, interestingly, in the last 2 years is that there's been a pretty strong rebound, backed by 2-3 things. One, of course, is I think the companies have also sort of pulled up their act, and wherever they needed to sort of improve processes, etc. I think that has come through. But more importantly, also there are 2 forces at work. One is the fact that if you see it from a global context, there is a certain amount of diversification to China that needs to happen. And when it comes to the export markets, I think there is recognition that India can be a very meaningful diversifier away from China, and that is giving rise to a lot of opportunities for companies, which is there. The second part is, of course, the domestic market, and which is again we are seeing much more opportunities getting thrown up. And here I'm talking about some of the other unorganized spaces like diagnostics, etc., where again things were maybe a little bit more informal, and there are the formal chains, etc., are able to capture and benefit from moving into a more organized space. Also, there is a recognition that there is need to step up on the R&D side and new research side, and there is historically, again, the industry has been more focused on generics, etc., and we are seeing that value addition coming in terms of the research spends and the research focus that is coming in. And the final point is we've seen last year a potential game changer in the form of the production link incentives that the government has brought in, which to encourage the manufacturing, large manufacturing plants in India. And again, that for this sector is potentially, we believe, quite a big story. So all in all, it's a few things which are coming together. Of course, in the near term, there can always be timing-wise ups and downs, but we think that the medium to long-term future of this space is very bright.
Well, I believe the subscription is open till May 10th, so I wish you all the best for that. Thank you so much, and happy do create wealth for the investors.
Thank you so much. We really look forward to having investors participate and benefit from this opportunity. And thanks a lot for having me on the show.
No, the pleasure is ours. Thanks so much, Ashwin. So, well, that's the representative from Axis AMC talking about this latest offering from their end. Now, as is the want, and something that we do on the mutual fund show every time, that while we've gotten the representative telling you what the offering is all about, it's actually a fairly simple offering, frankly. But still, it was important to get Axis AMC to do this. Now, the idea is to get in somebody who would have analyzed this in some detail, and then therefore can tell us whether this is a good offering to look at, or are there other offerings. If you want an exposure to the healthcare space. Tarun Birani joins us right now. Tarun, I think you're on mute, but thank you so much for taking the time out and speaking to us today. What's your sense, Tarun? I know you don't usually prefer thematic funds as a practice, but if somebody wants an exposure to the healthcare space, have you tried to look at this ETF? It's a simple product. How do you like it? Why don't you like it? If you don't, can you tell us a bit about it?
Yeah. So, Niraj, as we talk, this is one of the biggest black swan event we all are going through. Last 1 year, we have seen this pandemic is testing the mankind at a different level. And as we speak, India from a healthcare point of view, this space is completely a space wherein the medical, when I talk about mediclaim, by availability of hospital beds, availability of let's say hospital infrastructure, that's at a very, very abysmal level. And from that point of view, if I look at this healthcare as a space, there are definitely a lot of opportunity. The diagnostic side, the manufacturing side. India is considered to be a research and development hub. So there are definitely a lot of good companies available. And if I look at it from a 10-year structural point of view, this category has delivered great returns. So there are a lot of existing funds available in the market, which has delivered upward of 15 to 16% CAGR from a 10-year point of view. And the average returns of the healthcare funds available in the markets have been between 11 to 13%, which is way higher compared to the Nifty level. So from that, and looking at from a next 5 years, 10-year point of view, the awareness around healthcare is much higher. So this as a theme definitely looks as a very structural theme from a decade point of view. So anybody who has a risk appetite and able to look at sector funds on a regular basis can look at it. This is basically for sophisticated investor who has access to a lot of information, who have been tracking these stocks indexes on a regular basis. So from that point of view, one can definitely look at having some exposure in that a healthcare fund. But I definitely like diversified funds better because their fund managers have the access to buy healthcare or any other stock which he likes. So that gives investor the access to this sector any which ways. But from specifically talking about the fund you are talking about, the ETF, I see from a 10-year, 5-year data point of view, the information asymmetry is in favor of active funds in this space because 5 to 10-year point of view, the active funds have done much better. The pharma, healthcare active funds have done much better than the index fund. But yes, from a last 1 year point of view, active as well as the index funds are more or less at the same level. So yeah, that is where we have started to see a lot of index funds getting into the markets. But healthcare as a space, there is definitely much more research required on the stocks. So I think the information asymmetry is there. So
Right.
Active funds can be preferred. Yeah.
So you say that instead of buying the Axis ETF, it is better to choose an actively managed healthcare fund.
Yeah, that's what I can see from the data point of view. That is giving me much more confidence to look at active fund if anybody wants to look at healthcare space.
So are there any good options that you would have or you would be comfortable telling you would have had your clients buy in the last, say, 6 to 12 to 18 to 24 months, actively managed healthcare funds?
So we don't advise sector funds because we definitely like the fund manager to look at diversified funds and they take the calls on the sectors.
I get your point. Okay, but
so, there are funds like SBI Healthcare, Nippon Healthcare, which has a track record of 10-year plus, and they have given very good returns compared to the benchmark. These are both active funds.
Okay. So, well, viewers, here's the deal. Tarun doesn't per se, Tarun and his team don't quite recommend thematic funds, but if you want to go for a healthcare option, maybe actively managed funds are a better bet. His analysis suggests that the last 10 years, the actively managed funds have done better than what a passive ETF would have done had this been launched then. So compared to the index, so to say, and therefore maybe active funds have a better history. Okay. Or a better possibility. Let's put it that way. Please do your own research before you decide to invest or not invest in this ETF. Of course, we are just trying to get you the best opinion possible. Tarun, let's move on. So we spoke about this healthcare option. There is a lot of, how do I say, a lot of opinion needed that for people who have money, that they want to park some of the money safely with the best returns possible, with the time horizon between 12 to 18 months, ideally about a year or slightly over a year, right? Now, my question is, if and on the non-equity side, what would the best category be for that time period? And what are the kind of returns that should be anticipated? And what are the funds that you believe are the best options in that space, in that category?
Right. So as we talk currently, we are going through an environment of softer interest rates, and globally, with a $15 trillion of fiscal stimulus given by most of the central banks, and Indian central bank is no different, and we are seeing the chance towards more softer interest rates. So the yields in the space which you are talking about, 12 to 15 months, are currently ranging between nothing less than 4.5% kind of yields are ranging. And if I look at a debt fund from a 1 to 2 year with a taxation point of view, the returns are nothing less than 2.5-3%. So the returns doesn't look very attractive from a post-tax point of view. In this current environment, a category called arbitrage fund is looking better, because the last 2-3 expiries we are seeing the spreads available are more than 5%, 5.5% spreads are available in the arbitrage category. So somebody with a 1 to 1.5 year view can look at an arbitrage fund, because there you have the taxation benefit, long-term capital gains at 10% and short-term capital gains at 15%. The post-tax returns are much more efficient in that space. Otherwise, apart from arbitrage, one can look at a short-term fund with a 2-year kind of maturity, and there the yields are closer to around 4.5 to 5%. So that is the kind of expectation of YTMs which are available in the market, and one can look at. Yeah.
So with the 12 to 15 month horizon as well, a 2-year duration fund should be looked at.
Yeah, so I feel a combination of arbitrage fund and a short-term fund can be taken with that kind of horizon. Maybe 50% in both the categories.
Okay, and arbitrage funds you said might return about 6.5-7%, if I'm not wrong. Did you say that?
No.
The
every month you get the last day of the expiry, you get the spreads available in the market. So based on the last rollover which has happened, the spreads are close to 5 to 5.5%.
Okay.
Yeah? So that looks much attractive compared to any other liquid or ultra short-term options.
Got it. Okay. And Tarun, any arbitrage fund would be worth its salt, or are there some really good ones out there?
So one can look at funds available from most of the bigger fund houses like Kotak, ICICI, IDFC. All are doing well. So I don't see the spreads are much different between each of them.
Yeah. Okay. Fair call. Now, Tarun, so here's where we leave the floor open to the advisor. I'm not laying restrictions about time frame. I'm not giving you restriction for the category. Just a category and a fund within that category which you believe is looking really interesting right now. It could be for any reason. Please spell out the category and also spell out the reason and what kind of people should opt for that.
Right. So one category which, Niraj, I feel is completely unused by investors in India is the global investing category. We Indians have been overly focused around the Indian markets. Most of our investment, if I look at my personal investment also, for a year back or 2 years back, I think all our equity exposure used to be in the Indian markets. But largely, if you look at the problem is one is diversification. You are focused only on the one market. That is one. Second, you see a constant rupee depreciation happening from the last 10 years. If I look at 4% is the rupee depreciation which has happened. Apart from that, the best of the better managed companies are not available in India. So from that point of view, I feel one should look at diversifying outside India. And as I'm doing much more research around the global investing piece, and as part of the client portfolio, I spoke to a lot of advisors out in US also, and they look at outside the US market almost 20 to 25% of the portfolio. That gives a meaningful diversification to the investors. I feel in Indian scenario also, if you look at the world GDP composition, US, Europe, Asia, all these 3-4 geographies take over the entire GDP composition. But my money is only in India, right? So when investors are also looking at, they need to divide their money into developed market as well as emerging market. And to start with, I feel 15 to 20% of your portfolio, and I am making a bigger bet because one need to start meaningfully looking at global investing, and maybe 15 to 20% of your portfolio you can look at this category. And in that also 70% could be developed market and 30% could be emerging market. What do you mean by developed market? Economies which are much well regulated, much more developed markets like US, Europe, where so these could be looked at. And in the emerging market, you have markets like China, Korea, Russia, Brazil, India, all these come under the and now the good part is in India we have a lot of global investing funds options available, and most of the fund houses have one or the other global investing funds available. As we speak, we have almost 20,000 crores of asset under management, 20,000 crore plus asset under management in this global funds. So if I have to look at from a developed market point of view, funds like Franklin Feeder Fund, funds like PGM Global Opportunities, funds like Edelweiss, all these funds are great options available. ICICI, one can choose one of them as part of their developed market allocation. In the emerging market allocation, one can look at, again, Edelweiss has an emerging market fund, Edelweiss has a China fund. So all these, again, funds could be looked at from a emerging market allocation point of view. The good part is the correlation with the Indian markets is less. So it will help you diversify in the periods, and the correlation study works out to be 0.6 compared to the Indian markets. So that gives you a meaningful diversification. Because in India, let's say a Bengal election happens and the market fall, it will not happen with a Korean market or a Chinese market. So you are that way, your portfolio is much more balanced, and over a long period of time, the risk adjusted return on your portfolio will be much better. So my strong suggestion to everyone, and again, this space is a little sophisticated because there are a lot of currency play also comes into that play. So one need to take a very informed decision, need to study these funds in detail, their track record over a long period of time. So maybe you need to sit with your advisor to understand how much exposure you can look at it from a time frame you have available. Again, from your kids' future point of view, also we all require funds available in dollars. So this again could be an attractive option. So I see a lot of need for this global category in your portfolio.
Got it. Okay, Tarun, we'll the point well taken, and thank you for the recommendations. And thank you for being a part of this edition of the Mutual Fund Show. Stay safe.
Thank you. Thank you, Niraj.
Yeah. And viewers, thanks for tuning into this leg of the Mutual Fund Show.